Hello, this is Fred Paine with Private Family Banking Partners. Thank you for joining us for this presentation of how to build wealth and keep it. Wealth is not measured by how much you make, but how much you keep. This is demonstrated by the Rothschild family. This is the richest family in the world today, and their patriarch, Mayer Rothschild, was a banker. He not only left them a sizable inheritance, but he left his family with a system for building wealth. That wealth-building system consisted of three parts. Number one, the family's wealth was to be kept together in one family bank. Number two, the family could take a loan from the family bank, but they needed to repay that loan. And number three, the family met once a year to share their lessons learned. What worked, what didn't work, what made money, what didn't make money. And if they didn't do these things, they were out of the family bank. The Rothschild fortune currently is estimated to be somewhere between $1 and $100 trillion. I've even heard estimates of as high as $500 trillion. They're the richest family in the world. They've got some negative connotations associated with them, but they know how to make wealth and keep it. We want to show you tonight how you can build wealth also and keep it using some of these same principles. The average American makes over $1 million a year. He just doesn't keep it. For example, if a person earns $500,000 a year and saves it all, and they could grow their savings at just 5% a year, they'd have over $6 million after just 40 years. Let's take a look at this calculator. $50,000 over 40 years is going to grow to over $6 million. But a wealth stealer comes along, we call it taxes. Let's say this person is having to pay 28% of his income in taxes. Well, what that's going to do, it's going to decrease the amount of money that he has available to him. And then his lifestyle after taxes is going to take some more spending. Now, we can't stop our spending because we need to have transportation, we need to have housing, we need to buy groceries, we need to provide for our family needs. So let's say he spends 90% of his after-tax dollars. Well, that's going to make a real significant difference in the amount of money he has available at the end of his life. And he tries to save 10%, and that's shown by the little green line there. And what do? We spend all of our time trying to make that little 10%, that little green line, grow at some good rate of return. Well, what's the answer to get ahead then? Most people think that in order to get ahead, they must work harder, they must stop spending, or they must take more risk. But there comes a point where we can't work any harder than what we're working right now. And we've already established that we have to spend. We can be frugal, and we should be good stewards of what we have, but we have to spend money to meet family needs. And so that leaves us with take more risks. Invest our money somewhere where it can grow at a rate, and that's going to involve taking risk. But risk is another wealth stealer, because if we lose money, as we'll see later, it's going to keep us from gaining what we were wanting to do. So there's three ways to view money. We can view money as a spender, we can view it as an investor, or we can view money as a banker. Let's look at the spender. The spender views money as a way to buy stuff. But every purchase costs interest. Whether we borrow to purchase what we need or whether we pay cash for it, it's going to cost us interest. We either pay up by borrowing and paying someone else interest, or we give up interest that we could have earned on that money. Either way, we never build up. Let's take a look at what this looks like on buying cars. There's three ways to purchase a car. We can borrow the cash and pay that back to a bank, or they'll come get the car. We can save our money until we accumulate enough cash and then liquidate that cash and pay for the car that way, and then we lose money on the interest that would have earned. Or we can use the private family banking system. Take a look at this graph. Let's say we purchase a $30,000 car. Now, when we're younger, cars may not cost us that much, but as we grow older and hopefully more affluent, we might buy cars that are more expensive than that. But let's assume that the average of the cars we bought in our lifetime is about $30,000. And let's say we're going to borrow and pay for those cars at 5.5%, and that we buy a car every 5 years. Well, after 11 purchases, the borrower has spent $378,203. The cash buyer, who's being a little bit smarter by saving that interest, has spent $330,000. Well, over 55 years, that's a difference of only about $48,000. That's maybe significant, but over 55 years, yeah, you think we could do better than that. Well, let's look at what the bank did by being the middleman in this transaction. The bank took the money that the cash buyer was saving in his bank, lent that money to the borrower, and charged the borrower interest. And how much money did he make in this time? Well, let's take a look. He made $380,820. Now, the banker didn't make the car. He didn't sell the car. He didn't buy the car. All he did was act as the middleman for the borrower and the cash buyer. The banking business is a very lucrative business, as you can see from this example. That's why people spend many years, lots of money, and they spend it to get a bank charter, build a building, hire employees, start taking deposits, and then start lending those deposits to people who want to borrow. It's a really good way to build wealth. Here's another way to illustrate that. The borrower buys a car for, let's say, $20,000. Let's use something that's a little more conservative. Well, he goes to the bank and he borrows his $20,000. And after a year, he's paid back $5 of that $20,000. After another year, he's paid another $5. He owes $10. The next year, he owes $5. And finally, he pays the car off and owes nothing. And then what does he do? Well, now it's time to go buy another car. So he has to do that all over again. And over his lifetime of buying cars, he ends up, at the end of his life, with $0 and one old car. Well, is the cash buyer doing any better? Well, certainly he's doing a little bit better. He's saving some interest. So the first year he saves $5,000, and the next year he saves another $5, and he has $10. The next year he has $15, and finally he accumulates $20,000. And what does he do? He liquidates that $20,000 and buys his car. And then isn't it great? He doesn't have a car payment. Well, yes, he does. If he doesn't save another $5,000 the next year and another $5,000 the next year until he accumulates $20,000 for his next car, he's going to become a borrower and be down on the red line. So both the borrower and the cash buyer of this car are on a race. They're on a race to zero, aren't they? Zero and one old car is what they're left with. We'll take a look at what it looks like for the person that uses the private family banking system. There's the red and the blue lines indicating the borrower and the cash buyer. The private family banker starts off slow, but over time he accumulates a lot of money. The money that he would have lost by paying, the interest he would have lost by paying cash, and the interest he lost by borrowing. If he can put that all on his side of the equation, he ends up making well over $200,000. Well, that's what the spender does. Let's take a look at the investor. The investor views money as a way to buy something that he hopes is going to go up in value and that he can sell to someone else when it does. Well, every investment exposes him to risk, one of the wealth stealers in the world today. And every gain he makes costs him taxes. What does the investment risk game look like? Well, it looks like this. Imagine you have $100,000 that you invest and you gain 10% the first year. Great, now you've got $110,000. And the next year you lose 10%. Well, at least I'm back to even, you might think. But is that true? Well, no, it's not. 10% of 110 is $11,000. You're down to $99,000. You're not at even. And even if you work it the other way around, you lose 10% first and then gain 10% the year after that, you're still at $99,000. You have not made up the difference by gaining what you've lost. That's why the first rule of investment is never lose money. And the second rule is the same. Never lose money. Here's a chart that shows how much you have to make in order to recuperate any losses that you might have. If you lose 20%, the next year you're going to have to gain 25% just to break even. If you lose 50%, the next year you've got to gain 100% just to break even. Very unlikely scenario. And if you lose 100% of your money, then there's no amount of gain that'll get you back to even. You're broke, and you've got to go back to work. So risk destroys wealth, and taxes destroy our money's growth also. Let's take a look at how the banker views money. The banker views money as a way to make money. Every purchase is an opportunity for gain, and the banker always keeps his money working, earning compounded interest. It's purported that Albert Einstein was once asked what the most powerful force in the universe was. And his answer wasn't nuclear fission or fusion. It wasn't gravity. His answer was compound interest. Compound interest looks like what I call the wealth curve. The wealth curve starts moving up slowly, but eventually ends up growing exponentially. And this is what can happen if we put our money somewhere where it is growing at compounded interest and stays growing that way for our lifetime. Unfortunately, what happens is we fall off of that wealth curve. Just the purchase of one car at age 27, let's say, gets us off the wealth curve. Yes, we can still earn more money and we can get that money back on the wealth curve, but at the end of our life, that difference is fairly significant. It's $400,000. And we fall off the wealth curve time and time again. This doesn't happen just one time. So every purchase costs you interest. We either pay up when we borrow or we give up by paying cash. What if we could use our own money without giving up the interest that it would earn? Is that possible? Yes, it is. Private family banking allows you to be that middleman. It allows you to be your own bank. We can get you on the wealth curve for the rest of your life. How do we do that? We do that just like a bank does. What does a bank do? A bank takes deposits. It lends those deposits to people who want to borrow, and it earns interest by keeping its money working. So how do we do that? We'll show you how to create a pool of money. We put the money to work earning compounding, and we use that pool of money as collateral whenever we need cash. This is the key to the private family banking system. Don't take the money out and spend it. Use it as collateral and borrow the money from yourself, theoretically and most beneficially. If you borrow money at 6% and it's only earning 4%, would that make sense? Wouldn't it make more sense to liquidate your holdings than to borrow it? Well, let's take a look at that. Here's that $30,000 car being paid off in 60 months or 5 years at 6%. Our monthly payment would be $580, And when it's paid off after 5 years, we would have paid $34,799. $30,000 for the car, $47.99 as interest. If at the same time our money was growing in our savings for those 60 months at 4%, it would accumulate to $36,630. So it does make sense to borrow at 6% if you're only earning 4%. What's the reason for this? Well, you're paying off a loan at 6% loan on a decreasing balance every month, while you're earning on an increasing balance. You're compounding every month when you leave it in the bank. And so it is better to borrow at a 6% and earn at 4%. But wait, what if your loan interest rate is only 5% and you're earning at 5%? Well, then now you would have paid $33,968 for the car, and you would have earned $38,501. So you're ahead $4,500. Where can we do that? Well, it all depends on where we store our money. There's 3 places that we're told that we should store our money. One is we can store it in the stock market. But as we all know, the stock market goes up and it goes down. And although we can make money when it's going up as well as when it's going down, we better know what we're doing, and we better be paying attention or we're going to lose money. There's a big element of luck involved in making money in the stock market. And by the way, it goes up and down on the average of every 8 years. There's a crash. Then there's the house of sticks, which is real estate. We can put our money in real estate, and that's a safe investment, isn't it? Well, in 2010, we found out that maybe it isn't such a safe investment. Okay? Lots of people are upside down in their mortgages now. They owe more than their house is worth. A lot of people are losing their homes because of that. So maybe that's not the best place to put our money. The third place where we can put our money are financial instruments that have guarantees. And there's 3 of those that I can think of right off the top of my head: savings accounts, CDs, and insurance contracts. Now, savings accounts and CDs right now, that's like sticking your money under the mattress. But insurance contracts are paying about 5% right now. Well, what would the ideal investment look like? What would the ideal place to hold our money look like? Would we want there to be no risk involved with our money? Yes, absolutely. Would we want guarantees on our money? Yes. Would you like no penalties associated with this money? In other words, you can use it before you're 59 and a half without any penalty, and you don't have to start taking it out if you're 70 and a half and don't need it without a penalty. Would you want it to be liquid? Would you like to get your money whenever you need it? Would you want it to be protected from creditors and lawsuits? Would you want to create the most amount of wealth using the least amount of money? Would you want it to be leveraged? The answer to all of these questions is a resounding yes. Would you want your money to grow tax deferred? Absolutely. Would you want your money to be tax-free upon distribution? Yes. Would you want to use your money, do you want it to be available as collateral for loans? Yes. And when you put your money in, do you want payments to be tax deductible? We all say yes to that, but if you think about it, maybe a no would be the better answer. The GAO is saying that in 2013 they're going to collect $1.5 trillion in taxes. And the plan is in 5 years that 1.5 trillion will be 2.5 trillion. So we're probably in the lowest tax bracket we'll ever be in, and it's better to pay the taxes now when we know what they are than to pay them later when we don't know what they might be. Do we want our money or if we become disabled, would we want someone else to continue to put money into our contracts? Yes, we do. Would we want this money transfer to our family or to our heirs to be tax-free? The answer to that is yes. Well, let's compare the components of what we want with programs that we've already been funding. Here's a chart. IRAs, 401ks, brokerage accounts, our whole CDs and bank savings, annuities, real estate, and then our answers. This is what we want. And yet, look, we're funding things that don't always give us, very rarely give us, what we want with our money. So what do we use to build our private family banking systems? Well, we use the same financial instruments that banks, big corporations, and very wealthy people use to park their money. It's a place that's safe and guaranteed to grow. It's called whole life insurance or permanent life insurance. Banks purchase BOLI or bank-owned life insurance. It's held by most banks. It's recommended to them by the FDIC. And yet what do they tell us to do? Well, don't put it in insurance. Put it in investments or put it here in our bank and let us invest it for you. Permanent life insurance, however, is a safe, liquid way to hold and use capital. What we do is we customize your life insurance policy so that it gives you liquidity, it gives you safety, it gives you guaranteed growth, it gives you protection from taxes and protection from judgments. Here's a graph that shows 3 types of insurance. Term insurance doesn't give you any cash accumulation, but it does give you a huge death benefit. But after the term is over, that death benefit is going to cost you a lot more money. The typical whole life policy, which is represented by the blue in this chart, shows that it doesn't grow much cash initially to be able to use, but after a couple of years it starts to grow money and it does produce some cash for you to be able to use. This is the kind of policies that many financial gurus say don't buy. It will work for you, but it takes some time to grow enough cash to be able to use it. The green line, however, is what we do. We optimize your whole life insurance policy to produce cash. Cash that you can start using immediately and that grows exponentially over time. It's that wealth curve illustrated earlier. If you could control your own banking system, then you can capture the interest that you've been paying to someone else. The average American spends about 20% of his income on cars, about 30% on housing, and about 40% on other living expenses, and we're told you should save 10%. Well, the actual savings is a lot less than that, but that's what we spend today. Of that amount of money, about 34.5% is going to interest. What if we can recapture that interest for ourselves? Here's what it looks like. That's what we've been paying out in just interest to other people. How do we do that? Well, if we become our own banker by optimizing a whole life insurance policy, then the premiums that we pay are the deposits that we're putting into our money pool. And then we use that money pool to purchase cars or other equipment, to make loans that we would use our credit cards for, and we repay those. And eventually we can even take our mortgages over. My wife and I have been using this system for 5 years, and we're at the point where we're now able to take our mortgage over. And we're making those payments now to ourselves instead of to a mortgage company. How would your savings change if you could recapture the money you've been throwing away in interest? Well, it would look like this chart. That 10% now becomes 45%. And that is a great return on our investment. This is what it looks like for most people. We're down here below that zero line, saving a little bit and trying to make that grow. We'll show you how to be on the other side of this line, where you're recapturing that interest that you're paying someone else and paying that back to yourself and growing your wealth in a place that's safe, that's liquid, and that's guaranteed to grow. How else can we use our banking system? Well, we've helped people to eliminate their debts using this system. You can build a retirement plan with this system. You can pay for your children's college. You can finance your business. You can build multi-generational wealth. Thank you for listening to this presentation. If you'd like us to get you a free financial analysis, give us a call. We'd be happy to sit down with you and to customize a special policy that works just for you. Call me, text me, or email me, and I'll be happy to meet with you. Thank you again for listening to this presentation. God bless.